Right. Good morning, everybody, and welcome to this week's weekly show. The sort of keen-eyed amongst you might remember that when I presented the show last week, I said that James would be back this week. I'd sort of quite forgotten that he's actually enjoying a well-earned rest. So I'm going to be sort of taking you through this week's investment company news and then a little bit of property news. And then we're going to bring on Ian Parle, who's our special guest this week, to talk about Shire's income. So what's been going on in the world of investment trusts and property this week? Well, not a huge amount because, of course, we're sort of in the depths of the summer holiday, but there's a couple of things that have sort of come out that I just think are worth going over. Let's sort of hit these first. News from sort of US solar this week. There was a sort of, board put in a strategic review a little while back, and basically they were considering a number of options because it wasn't really working with the existing manager, and they've actually announced a potential new manager in the sort of form of Amber Infrastructure, and that is their sort of preferred candidate. Now, probably a lot of you will know Amber because it's actually the manager of INPP, but just to give you a little recap, Amber is a specialist infrastructure investment manager. It's got about 5 billion sterling of AUM. As I said, it's best known for managing INPP, which is no small beast, around sort of 3 billion AUM, just under when I looked today. And with that sort of comes 15 years of experience of managing UK investment companies, which is actually sort of very important. Key thing for many investors, actually the manager change is going to require shareholder approval. And the board has said consultations, presumably with the largest shareholders, are expected to be announced shortly. Key thing is obviously this is a US solar fund, so they have a US team. The team itself is based in New York, but actually the manager has got offices sort of throughout the US, so has a really good reach. And that team is responsible for managing 3 gigawatts of US solar projects, and it covers the sort of entire pipeline. So acquisitions, greenfield development from scratch, obviously asset management, as well as selling assets. So they're obviously well positioned to manage this fund. Should say this includes sort of full range of solar assets as well, from sort of large scale commercial rooftop installations, utility scale, as well as increasingly important now, co-located battery projects. I think this is a very good result for shareholders. This is obviously a very credible management team, and they've got the capacity and the scale to run this problem. I think one of the big problems is that actually, this fund desperately needs, and I think deserves to grow. It's got a market cap of just over 200 million US, and it's a sort of 35% discount. So that is going to be a problem. But I think, if they're able to address this issue of the sort of uncertainty over the manager, and obviously there are some structural issues, obviously these funds tend to be at discounts at the moment, there could be an opportunity to grow this, and there should be, because the scale of the opportunity in the US is absolutely huge, and there's a sort of supportive regulatory and political backdrop from the moment. And just think of the Inflation Reduction Act and all of the sort of measures, effective sort of subsidies, tax incentives, etc., that sort of roll into that. It's a lot of money. Some people have sort of raised the question with the IRA of what that could look like if we sort of have a Republican administration come back in the sort of forthcoming presidential election. And I think the reality is, obviously Republicans tend to complain about such acts desperately, but the reality is, once the sort of congressional pork barrel is rolled, these things just don't get rolled back, because actually they want their share of the pie as well. So I think overall, very, very good outlook there. And as I say, it is, although it works in a different way to the sort of market over here traditionally, there is a huge opportunity, and is very much needed. Next thing is just a little bit on Ruffer. Ruffer has broken the seal on share buybacks. Now, and I think this is sort of the move thus far is tiny, but it's quite symbolic. Fund was launched in sort of 2004, so it's 19 years old. It's not needed to repurchase shares for many years because it's defensive, it's been well managed, and it's been in demand. And as a result, it's tended to trade around par or a small premium. There's been a few times where it's sort of traded at a deliberate discount for a while, but not that long. This sort of latest, or this first inaugural repurchase, is just 150,000 shares. 0.039% of its sort of issued share capital, so less than 4 basis points. It is not a lot, but actually I think the implications could be bigger. Just to give you some context, I took this off our website last night. You can sort of go and have a look. This is in our fact sheet page. This is a 10-year chart. And basically, you can see sort of how in the post-COVID period, actually, it's done very well. It's been in demand. NAV has grown strongly overall. The sort of last 6 months or so, basically, we get into 23, have been the exception. And the sort of next chart will sort of show that. Well, if you look at the little chart at the bottom on this slide, you can see as the sort of performance is rolled over, you get a little bit of a lag, but actually then it's moved out to a discount. Now, as a 10-year chart, you can see that this really has sort of very rarely traded at a discount. There's certainly periods where there are sustained premiums, and the discount has never really been that wide. I mean, it doesn't get much above 5, maybe sort of 7%. It's sort of rare if it spikes above that. If you sort of look at this 1-year chart, you can sort of see this in a bit more detail. Once again, sort of last year, you sort of start to see performance coming off. You can sort of understand reasons why inflation picking up, interest rates rising. Obviously, this is very defensively positioned, but that's obviously relative. And you can start to see 1-for-1 discount sort of or start to gap out with a bit of lag. And it's been a while, as you can see, since this has happened. I think overall, the fact that the board has decided to do this is actually a positive development. We've long said that funds that raise a lot of money when times are good, if they want to be able to do that in the future, they should provide some liquidity, so that those shareholders that need to get out know that they can get out sort of roughly around par, or there's some certainty at least. Ruffer has the capacity to do this. I mean, its market cap and total assets are still over $1 billion. Large giant portfolio is liquid. I mean, at the absolute margin, if you're taking shares out of the system, you obviously would be reducing liquidity and you're spreading, your fixed costs over slightly greater asset base. But quite frankly, we don't see this going to adversely affect the fund's operation in any kind of material way. It is worth reminding people that actually, although it's little used, Ruffer has an annual redemption facility. It can redeem up to 25% of the fund shares. This next comes up in October. Given that it has moved out a little bit of a discount, this should allow, if the board want to deploy it, to sort of mop up any excess capacity that there is. As I said, this is rarely used. They last used it in 2007 when 16% of the shares were repurchased. Just to sort of give a bit of context versus its peers, the other sort of big funds in the flexible investment space, which people might be considering, particularly in sort of light of current market circumstances. There are sort of 3 that stand out that are very, very good, or 3 others, I should say, that stand out as being very good for capital preservation over the long term. So personal assets, capital gearing, and REIT capital partners. Personal assets and capital gearings, actually, their discounts tend to trade much closer to par, but that's because they've made a commitment to do so. Ruffer hasn't made such a commitment. But to come back to my point, that given the way that they've sort of continually raised funds, we think it's sort of reasonable that they do something. Capital sort of gearings, I think, is the slightly wider. Personal assets trades are very, very close to par. I think we looked yesterday about 0.5% discount to NAV. Capital gearings is sort of closer to 2.5%. Then it's sort of been 2 and a bit percent for sort of quite a while now. Now, interestingly, if you sort of look at the other big one that I mentioned, REIT capital partners, this actually is the best performing in NAV terms over 3, 5, and 10 years. And actually, in difficult markets year to date, so the last 6 months, it's actually the best performer out of these 4 as well. Yet it's the one that's on the big discount, 20.2%. So I've actually put pen to paper on this. So if you're interested in stuff, there's a sort of QD view that will be coming out later today, which will look at what the impact might be if the sort of tide goes out further and what the opportunities are. Now, anybody who tuned in last week would know that there was a big ramp up in the war of words between the board and the manager of Thomas Lloyd Energy Impact. Given what had happened, I sort of took the opportunity and spent quite a lot of time recapping. So anybody who missed that, I suggest have a look at that. And it sort of goes over really everything from scratch up until the end of last week. The key development was this week is that the first of the managers requisitioned EGMs took place yesterday, and so one of the things that sort of started all this was that the manager owns 15% of the fund, and it had requisitioned the board for an early continuation vote because one was due at the AGM anyway. And really, the board felt that the manager was trying to rush this through when the accounts hadn't been published, and that led to a suspension of the shares, and that shareholders didn't have enough information. And one of the things we learned last week was that actually a whistleblower had said the manager had known a lot more about the problematic RUMS project, which is a big project in India, and the sort of problems they had with financing of that a lot earlier than they'd actually told the board. And apparently it sort of appears that they have misled the board. There's a big row over it, but the board had strongly encouraged shareholders to basically vote for discontinuation and said, it doesn't mean that it's the end of the fund. They will sort of look at options. Well, we had that EGM this week and AGM, and basically, shareholders have got behind the board. So I've realised I put a typo in there, but it's basically won 58% versus 42% for continuation. And the key thing is that actually this is with the bulk of shareholders as well. So 91.5% of his share capital were behind that vote. So really, there just isn't the margin to do anything else. And I think this reflects the fact that actually it's quite well held by institutions who are able to get out and do the voting and tend to. It can be harder for sort of retail to do that because they're sort of behind nominee accounts, etc. What this means is now the board can bring forward proposals for the fund, and we can talk about that in a minute. I just wanted to show you, sort of what I was saying there. So this was the sort of vote for the general meeting. As you can see, sort of 42% versus 58. Pretty much everybody voting. Now, there was a continuation of the adjourned AGM, and it had exactly the same resolutions, slightly sort of lower number of votes in that, oddly, but still actually I've got the wrong way around, slightly more, 92.3%. As you can see, 41.9, 58%. This was never going to get through. I think shareholders done the right thing. As I pointed out last week, the manager with its shareholding has requisitioned the board for a second general meeting at which it wants to kick off all the members of the board and replace them with its own nominees. As I said last week, I think shareholders would be mad to vote for that, and I'm just going to reiterate, can't see how that will pass. I think the manager would be sensible to withdraw its requisition, to be honest, but we will see what happens. Now, I'm not going to cover this in great detail, but Richard Williams went over the sort of rumours that Ediston Property and a sort of US REIT, Realty Income, were in talks about a sort of potential acquisition of Epic's portfolio, and the sort of rumours were quite rightly reported that they were close to reaching a deal. As I said, deal is to buy the portfolio, sort of rather than the company itself, and then obviously something else will be done with that, presumably wind up and cash returned. Just to give a little bit of context for anybody who missed that, board launched a strategic review in March. It was frustrated by Epic's persistently wide discount, which was sort of north of 20%. And options have always included a merger or sort of sale of the portfolio. The key thing is Epic has actually confirmed the rumor. Basically says it notes recent press speculation and confirms that it's in advanced discussions with R1 UK1 Limited regarding a possible sale of its property portfolio. And that R1 UK1 Limited is a subsidiary of the Realty Income REIT. I should say that Richard sort of covered it last week. There were rumoured to be some other interested parties with this sort of now on the table. Though it's not a firm offer, maybe this will help actually pull some of those out of the woodwork as well. And that's as much as I wanted to say on that. Last little bit, just a couple of things come through on Home REIT this week. These are sort of not going to massively sort of shift the dial, but might have got sort of swept under the carpet with a lot of people being away. So just to draw your attention to the fact that shareholders have approved a new investment policy, and the appointment of AEW as manager, which makes utter sense as far as you can see. There's a quality manager in this space, and hopefully they can do something to help sort this sort of mess out. Other piece of news is one CIC, which obviously was a significant tenant, has agreed to surrender leases on 100 properties within Home REIT's portfolio. That's about 418 beds. So one CIC was effectively an intermediary here. Mears Limited, which is the sort of housing and social care provider, that was actually the other side of it. Has been subletted from one CIC, and the key thing is actually these leases are going to transfer directly to Home REIT. So it's actually going to cut out one CIC as the middleman. And basically there's sort of roughly 6.6 year term remaining, and it will apply for the remainder. Now, here's the sort of interesting thing. There's obviously been a realignment of the rents here. So the new initial contracted rental income is going to be just under £900,000 per annum. And this is expected to generate significantly higher rent collection, despite there actually being a lower headline rent. So the rent was previously just over 1.2 million. So you can see that actually on paper, they're sort of losing theoretically about 25% of the rent, but actually they expect they're going to get more. So I mean, it's all very well in theory, that being the headline rent, but if you can't collect, you can't collect it. And that, I think, is the sort of end of this week's sort of investment company and property news.